All right, good afternoon, everyone. We want to welcome clients, friends, CWG team. Welcome to our market economic update. How can we be in the fifth month of 2024? Time does fly. So again, thank you on behalf of Cliff and myself. We want to thank you for joining us. We're going to dive into what we've been looking at, watching 2024, and what we might see ahead for the remainder of the year. My name is Jeff Carbone, managing partner, founding member, certified financial planner at Cornerstone Wealth Group. As always, joined by Cliff Hodge, our chief investment officer, chartered financial analyst, and partner. Welcome, Cliff.
Great to be with you, Jeff. Looking forward to it today.
As always, Cliff, I know you got a lot of information to share, and I know we're trying to get better, simplify, share stories. But I know it's a lot of stuff, and we do want to keep high level, but try to simplify it down as well. Again, we want to say as a reminder, we're going to be recording the session. So if you miss something, you want to revisit it, share it with your friends or coworkers, colleagues, feel free to do so. We'll also post it on our website. It will be on our Facebook page and our YouTube channel. So don't forget to go to our Facebook. Join us on Facebook, join us on our YouTube channel as well. Our mission is always to provide you with clarity and confidence as the cornerstone of you, our clients' financial lives. Our agenda does not change. It's really going to go back. Cliff's going to start off with a 2024 review on the markets, the economic outlook, talk about expectations, and I'm sure, Cliff, you'll be talking about interest rates. I'm sure you're going to talk about inflation. I'm not going to steal thunder. I'm sure you're going to talk about wars, elections, just a few things that I'm sure are on your topics of agenda today. Once Cliff goes over that, we'll switch to a little bit of outlook and positioning. Always a few takeaways for you to look at. So again, it's a fair amount of information. So Cliff, I know, again, we started this year off, let's call it Q1 because we're now again in May, but Q1 saw the S&P up close to 10% while fixed income struggled, where you saw the 10-year start the year at about 3.88 in that range and jumped up almost 4.35 or so, and it's gone even higher. But for the quarter, fixed income was down about 1%. So kind of the correlation between equity and bonds has alleviated, unlike 2023. So markets did take a pause like they did recently. Well, recently took a pause in April, just like they did in early winter last year. We saw the Mag 7 back in October take a breather, and the Santa Claus rally kicked in. The New Year bump as the markets kicked in pretty nicely for Q1. But as we started April or finished April, certainly a little bit more volatility. Market did take a breather here, and Cliff will talk about that. But May has seemed to be, again, risk-on approach may be coming. And some of that may be from some information that came in the other day. We saw the slowing or a slowing indicator with payroll employment. The employment data came in. Did that lead to an indicator maybe of inflation coming down? Were we going to see some rate cuts? Is that really possible? Well, sure it is. But again, we're going to talk about why maybe it's not happening yet. But again, could be a likely, but we're going to continue to watch that. Retail investors are making investment decisions based on their dreams coming true, and the Fed lowering rates into the year end, and whether those dreams and aspirations happy, we're gonna be following that and watch it. May not be realized, so don't count all the chickens before they hatch. All right, Cliff, I know Joe, Craig are probably rolling over as they listen because they probably thinking Jeff's talking too long. So I'm going to toss it over to you. Give us a little bit of the start as we've seen here in 2024, and let's get going.
Yeah, thanks, Jeff. And but before we dig into the slides here, a wise man once told me that if you want to inspire people, you got to tell a story and not just focus on the charts. So we're going to give that a shot today. We'll kind of paint a picture on the front end we're going to cover a lot of ground. It's worth painting a picture on the front end around what we're seeing and then what those broader implications may be before digging into the weeds and going through a bunch of charts. So by and large, the message is right now it's a pretty nice picture. The GDP growth is positive, slowing down a little bit, largely driven by the consumer who continues to spend at a pretty high clip, who also happens to be supported by a reasonably strong labor market. So we've now had over 2 years with an unemployment rate of less than 4%. That is a new record, certainly a welcome record. Inflation continues to broadly slow down, though that last mile, as we've talked about, has been a little bit bumpier than many have anticipated. And while we think that further progress is likely, that 2 to 2.5% range may be more like a floor rather than a ceiling. What we've seen and grown accustomed to here over the last decade with really low interest rate environment. Equities are doing well overall, as you mentioned, but do remain expensive. 6% correction in April has taken out some of the froth in the equity markets. And most importantly, we're going to spend some time on this. We'll highlight it with some slides, but the policies from both the Federal Reserve and the Treasury are supporting risk assets, reaffirming the Powell pivot in the fourth quarter. And then we've got the seasonality of an election. Market typically does pretty well in an election year. And overall, our portfolios are performing well, especially the alternative investments that we've been pounding the table on here over the past couple of years. So that's the good news. That's the bright side of the coin, if you will. But as investors, our job is to be objective, and so we're also going to hit on and talk about some of the challenges and some of those things that we see. In high level, there certainly are some concerns below the surface. We mentioned valuations. We'll look at those. Even though the consumer is still continuing to spend at a high level, we are seeing some accelerating signs of stress. Things like credit card charge-offs, auto delinquencies are breaking out to levels that we have not seen since the aftermath of the global financial crisis back in 2008, 2009. The labor market, Jeff, as you hit on, is softening. Our indicators point toward that continuing, which ultimately could lead to layoffs in the future, while recession risk in 2024 remains pretty low. So the other talking point that is a major focus these days is our fiscal situation. The deficits remain a problem. There's a lot of uncertainty about how things are going to play out, both going into the election and then afterwards. So there's a lot to do. But the bottom line is that right now things are largely okay. We think conditions are in place for equities to set new highs over the coming months. And, as investors, we intend to take advantage of that opportunity. But we're certainly going to be keeping an eye on the off-ramp, so to say, because ultimately, our view is that we do think recession is going to be delayed for now, not going to be an issue in 2024, but could likely become more of a factor into 2025. So with that's the story. Now we'll dig into some of the details here. Let me get my screen share going and get these slides moving. You mentioned the agenda. So as we always do, we're going to start off with kind of what's transpired year to date. And Jeff, you did a good job mentioning this in the kickoff, in the introduction. Just a couple of comments I'll add. First, on equities, we are seeing some signs of broadening participation, which is a great sign. So it's not just a tech story anymore. You see things like communication services, energy, utilities, all beginning to participate in the rally, not just those magnificent 7 stocks that we talked about driving the train. We are getting a little bit more of a broadening, which we think is a theme that is likely to continue. As you mentioned, bonds are still lagging a little bit. The U.S. aggregate bond index down about 2%. That's okay. That's been largely an inflation story, an interest rate story. But with yields where they are, in that 4.5–5% range, we are getting paid to compound those higher yields over time. And as we'll see, the risk reward setup for fixed income is still very attractive. So certainly want to encourage folks to continue to be patient with their bond allocation. And now, would certainly say that now is not the time to be turning our backs on fixed income. So now we'll turn the page to the outlook. And some of this is new. We kept number 1 in place over the last webinar, but really want to focus on points 2 and 3. These are really the major updates for this quarter. First of all, pushing out the recession call. Feel more confident that is unlikely to be a factor in 2024. We're going to talk about why. And then that third bullet point, really the key takeaway is that we feel comfortable upgrading our equity allocation, our view on stocks, based on kind of a myriad of factors, but mainly this most recent updates from the Federal Reserve and the Treasury give us more confidence that the picture is going to improve for equities alongside the fundamentals, things like earnings as well. And really the main concern for markets in the first part of the year has been a fear of this perhaps additional inflationary wave that we've made good progress on disinflation, but there is a chance that inflation could actually reaccelerate. And we're gonna look at reasons why we don't think that's likely, and that the markets are set up for this more interim period of Goldilocks, right? Slowing growth, slowing inflation before recession fears kind of come to the forefront. And so we think that this sets up pretty nicely for equities here over the remainder of the year. And we can see that in the dashboard, right? As our clients know, that the dashboard is our visual cue that encapsulates our data-driven process. There are 3 legs to the stool. There's the macro, the fundamentals, and then the behavioral or the sentiment. And happy to report that there's certainly a lot more green on the screen today than what we've seen over the past couple of quarters. I'll call out some of these changes. Within the macro bucket, the macro quad setup is looking a little bit more interesting, more of a quad 2, quad 3 environment rather than where we've been in where the model is forecast quad 4, which is where both growth and inflation decelerate. The Federal Reserve, we've upgraded now to neutral based on some recent policy updates, mainly regarding quantitative tightening and Chair Powell taking rate hikes more or less off the table with forward guidance. The earnings picture is looking more healthy, and the sentiment or the behavioral aspects have gotten a bit more neutral and a bit more supportive. So high level, we think these are pretty positive developments for equity markets going forward. So now we'll look to dive into some of the specifics on the macro. We'll start with GDP. Q1 numbers were just released fairly recently, and we did see a little bit of a slowdown. The results actually came in lighter than expectations, mainly driven by more noisier components, things like trade, things like inventories. But if you focus on that gray bar, that is the consumer. And you can see a lot less variation, a lot more strength on the consumer side, accounts for 70% of GDP. And when we look below look under the hood of how the consumer is spending, we see a lot of stabilization and actually some improvements, right, in things like goods spending, both on the durable and non-durable goods side. So spending continues to grow at a pretty healthy clip. The spending environment is largely supported by a pretty strong labor market as well, which continues to produce new jobs. So what we're looking at here is the last year of the non-farm payrolls report, monthly data series. You can see that bar to the right, April was a little bit light relative to expectations. Interestingly enough, this data was actually welcomed by the market. We saw pretty positive reaction from equities. The thought being that a positive but slowing labor market is going to allow inflation to continue to cool, and then would allow the Fed to then follow through on those rate cuts that they've got penciled in for later in the year. one of the questions that we're getting a lot from advisors or clients is, we've had this really interesting period post-COVID where we've had very high levels of inflation. We've seen the most aggressive rate hiking cycle over the last 40 years. Why hasn't the other shoe dropped? This is something that we talk about a lot internally on the investment team as well. And from our viewpoint, there are really two main reasons. The first being that just as an economy, given a lot of the dynamics from the COVID era pandemic, we're just not as rate sensitive as we are in the past. So think about the mortgage market. 95% of mortgages in the US are 30-year fixed rates. Consumers did a great job of refinancing and terming out that debt during the zero interest rate periods of COVID. Same thing on the corporate side. A lot of corporate CFOs took advantage of low rates to lock in their financing and push out those needs to refinance into 25, 26, and even into 2027. So just the rate hike mechanism is not as effective as it has been in the past. And then really the other reason primarily is strong demand tailwinds driven by fiscal stimulus. So we think about the amount of money that has been flowing into the economy from things like the CHIP Act, the Inflation Reduction Act, maybe not the best name, but we get the picture, and the infrastructure bill, all have provided the kindling for this consumer spending fire that we've seen continue to perpetuate through the economy. And so that's largely the good news story, right? Things are going pretty well. Sentiment is benign. There are not any real major concerns that have bubbled up to the forefront. There's always things in the background. We'll talk about geopolitics, certainly. But as we do to be objective, we want to spend some time on the other side of that coin, to call out some of the things that we are watching and give some of the reasons why we think the recession ultimately is not going to be completely off the table. First of which is on the consumer. We talked about those pandemic era stimulus boost in the form of excess savings got to north of roughly $2 trillion in 2021, 2022. That has continued to be spent down. And according to various research providers, the thought is that those excess savings now largely have been spent. In turn, the savings rate, which is the chart on the right-hand side, pretty close to all-time lows. So consumers have been flush with cash. They have not had to save. That frees up dollars to then spend in the global economy, which supports GDP. Well, as those consumers are forced for one reason or another, could be layoffs, could be something else, to start replenishing those savings, that's going to decrease those dollars that are available for spending going forward. Again, the consumer drives 70% of the economy. So as that spending rate or that savings rate starts to tick back up, we would expect to see spending flow commensurately. Another one on the consumer. We talked in the intro about some signs of stress that we're seeing accelerate. So this white line here on the graphic down at the bottom, that is the net charge-off rate for credit cards. So broken out to higher levels than we've seen over the past really 10 years, back to levels not seen during the aftermath of the global financial crisis. Not at emergency levels by any means. Same thing when you look at 90-day delinquencies on credit cards and autos. They're just signs that not all is well when you look below the surface of the consumer. There's talk of this K-shaped recovery. Those that are fortunate enough to have assets continue to do well. Those without assets are getting hit by inflation as the cost of things like groceries and gasoline are eating into more and more of their budget. And we are seeing these signs of stress with the consumer, even though, as we mentioned, the unemployment rate has been below 4% for the past 2 years. And we've talked a little bit about this in the past, but we track quite a few leading indicators of employment. Those are continuing to slow. We may have gotten the first inkling of that in this month's non-farm payrolls report, as we mentioned. We think it's likely going to continue, especially if you look at things like hiring intentions from small businesses. That's what this graphic is showing here from the NFIB. You move that forward in time by 4 months, does a pretty good job of predicting the rate of change in private payrolls. And as you can see on the graphic here, likely going to continue following that trend down before ultimately going negative. When the non-farm payrolls go negative, that is certainly going to be a wake-up call for the markets and a sign for us that it might be time to start looking to de-risk portfolios. Last but not least, on things that we are monitoring, there's been a ton of publicity around our fiscal situation. We're running 6.5%, 7% deficits, which are the highest level, outside of COVID, global financial crisis, and World War II. Bottom line here is that we're going to be running out of room to keep spending. So is that going to mean that, as a country, we get more responsible about how we're spending money? Perhaps. Likely going to mean taxes are going up. Jeff, I know there's some sunset provisions in the tax code that come into play in 2025. A lot of that's going to be dependent on the election. But there are certainly some things that have our attention, though. As I like to say, we are not only seekers of truth, we are also makers of money. So we have to be sensitive to these opportunities that the market presents. So before we turn the picture to inflation, Jeff, any comments on the growth picture?
No, I think, Cliff, a lot of good information. And just while you mentioned taxes, I'll just jump in for a second here. Again, as Cliff mentioned, the tax code is set to expire at the end 12/31 of 25. So if from an estate planning perspective, from an income taxes are expected to go back to where they were in 17, meaning highest tax bracket of 39.6, and an estate tax starting at about 13 to 14 million for a couple or partners. So $7 million per person versus the current 13 million plus. So when you think about that, I was talking to someone from Canada the other day, and they said, well, they're floating. Well, Washington the other day floated out the possibility of changing capital gains rates from the current 20 max rate of 20% plus a 3.8 going to ordinary income tax rates. If you live in Canada, they're currently at 54%, and they're floating 65 to 67% cap gains rate. So we still are very fortunate in the United States, no matter what the tax rates are. So, but Cliff, let's get off taxes. Let's talk inflation for a little bit here.
Yeah, that sounds good, Jeff. I think we can all agree, the path forward on taxes, depending on the election and the administration, but just in general, probably going to be going up here over the next few years. So now we'll turn the page and look at the inflation picture, and really so far this year, it's that last mile of disinflation that we've talked about. That's really proven to be the hardest. If you look on the graphic here, there are some signs that CPI has actually accelerated a little bit. Core PCE, which is the Fed's favorite inflation metric, surprisingly rose during the first quarter. And the employment cost index, right, which is input into wages and into inflation, saw its largest gain in over a year. So naturally, this brings about a lot of questions about whether or not that path lower to the 2% inflation target is still encountering bumps, bumps in the road, or is this more of a problematic trend higher? And then you compound the inflation picture with some of the geopolitical developments. Russia, Ukraine rolls on. I know Congress just approved a new aid package there as well, which is not going to help that fiscal deficit. And the Middle East, it certainly has become a powder keg recently, which also caused a spike in oil and commodity prices during the first quarter as well. But good news on this front. So when we look under the hood at what has been driving this stickiness in that last mile inflation, the good news is that there are really two components which are, I'm going to go out on a limb here and dare I say transitory, part of the inflation story. And those two components are shelter and motor vehicle insurance, right? And if you think about, we go back in time and think about what happened during the lockdown, during 2020, and then the aftermath, housing prices surged, new and used auto prices surged as well. And so largely these two components are a catch-up to relics of the past, right? So as there's a pretty complex calculation for shelter into the CPI component. It's lagging more than everyone thought. The motor vehicle piece as well, completely related to that one-time increase in car prices. And as you can see on the graphic here, I mean, this is basically what we're measuring is what is driving that excess. So above expectations, really just two categories. And so ultimately, those should continue to stabilize, and that gives us more confidence that we are going to continue on this path lower in disinflation, which is exactly what the Fed wants to see. The other piece of the inflation picture, as we'll talk about, is wage growth. That is a key driver of structural inflation. And this is a much different picture than what we saw in 2021, 2022, where wage growth was spiking, right? We got concerns about this wage price spiral. As wages go up, companies raise prices, it becomes unhinged, and kind of so on and so forth. Well, when we look at one, the path of wage growth, we've peaked and have come back down and are starting to normalize. And the leading indicators, a lot of which we track around the labor market and wage growth, all point to continued disinflation in wages and continued softness in the labor market, which again is kind of that Goldilocks period that the Fed is looking for. And this gets picked up in our data-driven quad map. These are the four quadrants that drive a pretty key part of our investment process, especially over kind of the short to intermediate term. We can see that in 2Q, inflation does continue to be a little bit of a concern, but then you follow that dotted line kind of clockwise down to the left, indicates that inflation is likely going to continue to fall throughout the year. So that's certainly welcome news on the inflation front. I would say the thing that has captured our attention, really most acutely recently has to do with changes in policy, both at the Treasury, which issues all of our debt, and at the Federal Reserve. There's a lot going on in this chart, so I'm going to take a moment to break down what we're looking at here. That purple line is the S&P 500. The white line is the U.S. dollar index relative to a basket of other currencies, and that's inverted. So the white line, when you see that going down, that means the dollar is increasing. Same thing with the green line, which is the 10-year yield. I've inverted that as well, just so that it flows a little bit more visually with the direction of the S&P. The major development is that this past week, both the Fed surprised markets with the tapering of quantitative tapering, QT. So that just means that they are now going to allow a smaller number of bonds to roll off their balance sheet. That is 100% supportive of liquidity. We remember, after the global financial crisis, 08, 09, we had QE, which they were buying bonds. They've tapered it, which means they are no longer buying bonds and they're letting their balance sheet shrink. They are reducing that pace, and it's really a signaling mechanism that ultimately they are going to stop shrinking the balance sheet, which is very supportive of the liquidity picture. The other thing going on here that we wanted to call out is the QRA from the Treasury. That is the quarterly refunding announcement. That is when the Treasury announces to the market their estimates of borrowing for the coming 2 quarters. So we got 2Q and Q3 data. And then they also announced the composition, how much of the issuance of the new bonds are going to be on the short end, so Treasury bills, for example, versus the long end, 2-year, 5-year, 10-year, so on and so forth. And no surprise, especially in an election year, that our policymakers are pulling out all the stops to support liquidity. So a couple of reasons why I wanted to highlight this chart. If you look at the August timeframe here in red, that was a hawkish QRA relative to the market's expectations. That started the correction in the S&P, drove strength in yields, strength in the US dollar. That is negative for liquidity, negative for risk assets. The equity market happened to bottom almost to the day. In that November timeframe, that first green section there on the chart, that was the famed Powell pivot, which has sparked this rally that we've seen, really from November all the way through April. A little bit of agita here in the month of April. Surprise, surprise, the Fed and the Treasury come to the rescue at the beginning of May. And now, not surprised that we've seen the reaction that we have, where equities have kind of put in a bottom, started moving higher. The dollar and yields both have come off, which all else equal, good for liquidity, good for risk assets. We talk about this liquidity metric a lot because it has become extremely important to the markets and especially to stocks. We can see what happened again here back during the August time period. The S&P did a pretty good job anticipating liquidity coming out of the system. Same thing in this that second one should say October. There's a typo on that chart. And then last but not least, we get to May of 2024, and the S&P is turning higher, already anticipating this liquidity that is going to be flowing into the system. So if I had to say there's one overriding factor, there never is just one, but this is a pretty significant development that cannot be understated, the importance to the flow through of risk assets in general. That was a mouthful. Lot to cover there. We'll turn and go to the fundamentals. Jeff, any comments before we do so?
Yeah, no, a lot of information, a lot of detail, but again, as you said, I think this chart again that you're on right now shows a lot, right? The Fed was on a path and it's changed, and we can see the dovish signs, and the taper certainly is more of a risk on approach, and so it's some of those, they're popping up right now. So thanks for sharing.
Yeah, absolutely. All right, so we'll run through the next few slides here. I know we're already up on 30 minutes, so we'll kind of keep this high level. Moral of the story for valuations, broadly still elevated, but they have come off some at the index level with this correction that we got last month. I will say that we are a lot more constructive on what I'll refer to as the catch-up trade. So think things like value, right? You can see that trading at a pretty healthy discount to the S&P 500. Profitable small caps, the S&P 600. Those are a couple of areas that we are very interested. Technology on the right-hand side, if you look at the sectors, still at the upper bound. Technology, Magnificent Seven stocks, still very expensive. They've had a fantastic run. We are actively taking some chips off the table and some of these growth momentum names and looking to add value and profitable small cap tech, or I'm sorry, profitable small cap as well. We look at the earnings picture. That's the other piece of the fundamentals that's very important to our process. And no question, the earnings picture is improving. We bottomed out in Q3 of last year. We've now had 3 quarters of positive growth, quarter over quarter for earnings. Expectations are still pretty high, especially when you look out into the rest of the year and into 2025. That's okay, as long as these companies continue to deliver. And then we'll call this the election playbook, right? And the market is largely following this pattern, right? Where you see that, at the beginning of the year, you kind of move sideways, you have a little bit of a correction before then rallying into the election, digesting the results and what the potential policy implications are, before moving on into the end of the year and into the beginning of the following year. So seasonality, what I'll call this, as well, is a bit of a tailwind at our backs. Looking at bonds, the story here is that we're getting paid to compound high quality at higher yields. We see that in the yield chart on the left-hand side. You kind of get that, 4.5, 5+% range in some of the fixed income indices. However, you're not getting paid to take on big credit bets. So if you look at on the right-hand side, the option adjusted spreads, high yield kind of at the very low end of that band, IG corporate very low end of that band. That just says that the valuations are not there on the credit side. So we are okay. We're very okay being in boring bonds, staying high quality, and compounding that 5% yield every month, because we get a pretty interesting risk reward setup here. So love this graphic from our friends at BCA. We've seen it before. I'll draw your attention to the left-hand columns. You're looking at a yield level on the 10-year. That column directly to the right, U.S. implied 1-year returns. So this just says, all right, we're at 4.5% on the 10-year, which I think, I don't know if you can see my pointer, but 4.5% on the 10-year would correspond to roughly a 5% return 1 year out on a 10-year treasury. Pretty decent. In a bad scenario where yields go higher, last fall, the 10-year topped out at 5%. There's a chance we could go higher, 5.25%, 5.5%. I think 6% would be a stretch. Don't see a very likely scenario where the 10-year is at 6% anytime in the near future. So in that kind of environment, your downside is limited, likely in the single digits, maybe even you break even. But then the real payoff is in the great scenario for bonds, which is bad for the economy or a recession. We can see a world where plain old vanilla treasuries give us a high teens to 20% return in a scenario where the Fed has to cut pretty aggressively, say down to 2.5% on the 10-year. And I'm going to take this moment for a PSA and to pound the table one more time. This is the main reason, right, why we don't want to hold cash, why we don't want to be rolling T-bills or holding CDs. Because, yeah, they're going to give you a little bit of a bump in yield on the front end, but you will not get any price appreciation when and if the Fed cuts and interest rates along the curve come down. So this is why you want to have some duration in your portfolios, why you don't want to be hoarding CDs, because of this one-time price appreciation that you will miss out on if you are not invested prior to the cutting cycle. Lastly, check on sentiment. This is the third leg of our stool, pretty neutral, nothing really extreme either way. I will call out that on the retail side, the fear and greed index is the visual we look at. There is a little bit more fear in the market. Berkshire Hathaway just had their annual meeting. I'll steal the quote from Warren Buffett: "Be fearful when others are greedy. Greedy when others are fearful." There is a little bit of fear in the market. So again, from a sentiment perspective, helps to support our broader thesis. So just to tie it all together, quickly here, 3 bullet points. First off, we're upgrading equities to neutral. We're going to see that flow through into portfolios. We've kind of already started that process. We're focusing on high quality, relative valuations, looking for this rally to continue to broaden out. Profitable small caps are pretty interesting, large cap value. On the fixed income side, we want to be overweight in just high quality core bonds, compound that yield, and then look opportunistically for things that we can pair with that high quality core to give us a little bit more of an income kicker. So that's what we're doing with our bond portfolios here today. And then last but not least, alternatives. We continue to be ahead of the curve with alternatives. Worked out very nicely for our clients that were invested in 2022, working out very nicely again in 2024. We love the absolute return diversifying strategies, pairing that with something like private credit, where you are getting that incremental yield pickup over the public markets. We think that's a really nice pair in portfolio construction. Here's the granular view of what we just talked about. I'll highlight underweight growth, overweight value, small caps looking more interesting. private credit and liquid alternatives in the alt space are our current best ideas from an asset allocation perspective. So Jeff, we covered a ton of ground. Hopefully this is helpful. I will turn it over to you to see if we have questions and let you wrap us up.
Thanks, Cliff. Again, as always, I know a lot of information to share, and just trying to, again, continue to keep everybody educated and provide that clarity. So as you see decisions being made by the investment team, there's a reason, there's a plan, there's a process to what we're doing, and we'll continue to do so. Cliff, you kind of ended with the alternative. So I'm going to close out with a little bit of why we continue to pound the table. As you mentioned, you pounded it on fixed income. We'll pound it a little bit more on alternatives and why alternatives are continuing to be a big part of the Cornerstone story. If you turn on any business channel, Fox Business, Bloomberg, CNBC, right, whoever you're watching, private equity, private credit, private, the word of private is out there. There are over 18,000 private companies that make over $100 million. There's about 2,800 public companies. So there's a lot of private companies that give us opportunities that not everybody has. So there's reasons why. A lot of folks are under the time frame of it's summer travel season, right? We're going to be booking our flights or have already booked our flights, whether you're heading if you're fortunate to head to Europe, if you're heading down to the Caribbean, if you're heading to the Grand Canyon, Hawaii, California, wherever you're going, when you book that flight, on the website or when you were talking to a travel agent, if they said you've got an option to take a flight with turbulence, or would you like the flight without one? Which one are you going to take? Well, I know I'm going to take the one with no turbulence. I don't want less turbulence, no turbulence, if I've got that option. They both get you to the same destination. It's just the experience that you're taking when you're traveling on that decision, when you make that decision. That's what alternatives are doing. That's why we continue to talk about the story. Alternatives help provide a smoother, less turbulent investment experience, especially in the more volatile times and uncertain times that we continue to see, whether it be war and rises in inflation or deflation, whatever it may be. The investment team continues to work tirelessly, holding numerous due diligence meetings, building out a good alternative structure for, again, you, our clients. We're going to continue to do those deeper dives, find those assets that are not correlated with the equity and the bond markets. And over time, it's meant to provide a smoother investment experience for you. On behalf of Cliff, myself, the Cornerstone team, we thank you for joining us. We appreciate the trust and confidence you placed in us. It is never and will never be taken lightly. Keep an eye out for the email. Share it with your colleagues, friends, family. If we could be of any assistance to you, feel free to give us a call. Wishing you all continued health, wealth, and happiness as we continue 2024. Thanks, everyone.